In 2008, the world lost $11 trillion in just 18 months. In 2020, the stock market crashed 34% in just 33 days. In 2026, the Iran war sent oil past $100 a barrel. Millions of ordinary people lost their savings. Millions more lost their jobs. But here's the number nobody is talking about. After every single one of those crises, the number of millionaires did not go down. It went up dramatically. After 2008, American millionaires grew from 6.7 million to 10.1 million. After 2020, global millionaires jumped from 46.8 million to 56.1 million in just 2 years. That is 9.3 million new millionaires created during the worst global crisis in a century. Same crisis, same economy, completely opposite financial outcomes. Today we are going to show you exactly how that happened, why it keeps happening every single time, and what any ordinary person can do right now to be on the right side of this pattern. Let us start with the worst economic crisis in modern history, the Great Depression, 1929. The stock market lost 89% of its value between 1929 and 1932. Unemployment hit 25%. Over 9,000 banks collapsed, wiping out the savings of millions of ordinary families. GDP fell by 30%. It was complete and total financial devastation. But here's what the data shows about the people who did not run. The people who bought stocks at the bottom in 1932 saw returns of over 500% by 1937 in just 5 years. John Paul Getty bought oil stocks at rock-bottom prices during the Great Depression. His peak net worth reached $1.2 billion in 1957. That is equivalent to over $14 billion in today's money. Built directly from assets purchased during the worst economic crisis in history, JP Morgan acquired distressed assets at a fraction of their real value during the same period, laying the foundation for decades of financial dominance. Every single major American fortune built during the 20th century had its foundation laid either during the Great Depression or in the recovery that immediately followed it. The crisis did not destroy wealth permanently, it transferred it, from the people who panicked to the people who stayed calm and understood what was actually happening. Now let us move forward to the year 2000, the dot-com crash. This crisis wiped out approximately $5 trillion in market value between 2000 and 2002. The Nasdaq dropped 78% from its peak. Over $1 trillion in paper wealth vanished in a single year. Millions of ordinary investors who had poured their life savings into technology stocks lost everything. But here is the data that changes everything. Amazon stock fell from approximately $107 in 1999 to just $7 per share by 2001. The people who bought Amazon at $7 saw it reach over $3,000 per share by 2020. That is a return of 42,800% on every single dollar invested at the bottom. Every $1,000 invested in Amazon at its lowest point became $428,000 by 2020. Apple fell to under $1 per share, adjusted for splits during the same crash. It went on to become the most valuable company in human history. Microsoft fell 63% during the crash and went on to multiply in value by over 1,000% over the following 2 decades. The crash did not destroy these companies. Instead, it created the single greatest buying opportunity in the history of technology investing, and the only people who missed it were the ones who sold at the bottom out of fear, the financial crisis. $11 trillion of American household wealth wiped out. The S&P 500 dropped 57% between October 2007 and March 2009. 8.7 million Americans lost their jobs. 3.8 million foreclosures were filed in 2010 alone. Housing prices fell 30% nationally, with some markets falling over 50%. It felt like the entire financial system was collapsing. But here's what Warren Buffett did while everyone else was running. He invested $5 billion directly into Goldman Sachs in September 2008 at the absolute height of the panic. By 2013, that single investment had generated approximately $3.7 billion in profit. He also bought $3 billion worth of General Electric stock during the same period. The people who invested in the S&P 500 at the bottom in March 2009 saw returns of over 400% over the next decade. Every single dollar invested at that bottom was worth approximately $5 by 2019. The number of American millionaires, which stood at 6.7 million in 2008, grew to over 10.1 million by 2013. That is 3.4 million new millionaires created directly out of the worst financial crisis since the Great Depression in just 5 years. COVID. The S&P 500 dropped 34% in just 33 days, the fastest market crash in recorded history. 22 million Americans lost their jobs in just 2 months. Global GDP contracted 3.1%, the worst peacetime contraction since the Great Depression. Millions of ordinary investors panicked and sold everything at the bottom, locking in their losses permanently. But here's what the data shows about what happened next. The S&P 500 recovered its entire loss within just 6 months. The people who bought at the bottom saw over 100% returns within just 12 months. Global millionaires jumped from 46.8 million to 56.1 million in just 2 years. That is 9.3 million new millionaires during the worst global crisis in a century. Elon Musk's net worth grew from $25 billion to over $150 billion in 2020 alone. Jeff Bezos added approximately $75 billion to his net worth during the same year. The world's 10 richest men doubled their combined fortunes from $700 billion to $1.5 trillion between 2020 and 2022. While millions of ordinary people were losing their savings, the informed were building generational wealth from the exact same crisis. Now let us look at right now, 2026. The Iran war sent Brent crude oil prices surging from approximately $80 per barrel in March 2026 to over $102 per barrel by mid-April, a gain of 27% in just weeks. Some oil cargoes are trading at premiums approaching $150 per barrel. European gas prices went over 50% higher almost immediately. The IMF has downgraded its global growth forecast for 2026 from 3.3 to 3.1%. In the worst-case scenario, global growth could fall to 2.5%. Goldman Sachs projects inflation staying elevated between 3 and 5% annually through 2028. But here's what the data is already showing about who is winning from this crisis. The S&P 500, which was down 7% at the conflict lows, has since rebounded toward record highs. Lockheed Martin has a $194 billion order backlog. Northrop Grumman is up 6%. RTX is up 4.5%. ExxonMobil and Chevron are both up approximately 40% year to date. Gold has passed $4,300 an ounce, the highest level in history. Silver has hit almost $70. JP Morgan reported $16.49 billion in profit in just the first quarter of 2026, up 13% year on year. Goldman Sachs reported $5.63 billion in profit, up 19%. The number of global billionaires has risen from 2,095 in 2020 to 2,668 in 2023 and keeps climbing. Same pattern, same data, same result every single time. So why does this keep happening? The answer is mathematical. When asset prices fall during a crisis, creating a rare opportunity to buy valuable things at prices that would normally be completely out of reach. Compound interest then multiplies those gains exponentially over the following years and decades. According to JP Morgan, missing just the 10 best days in the stock market over a 20-year period reduces your total returns by over 50%. Most of those best days happen immediately after the worst days during a crisis. A $10,000 investment in the S&P 500 in 1990 would be worth approximately $200,000 today through every single crisis and every single crash. The same $10,000 kept in a savings account over the same period would be worth approximately $18,000. The difference between those two outcomes is not luck, it is not connections, as it is simply the decision to stay invested through the crisis instead of running away from it. So what can any ordinary person do right now? Do not panic sell. The S&P 500 has never failed to recover from any crisis in its entire history. Invest consistently through dollar cost averaging. A person who invested just $200 per month into the S&P 500 for the last 30 years would have contributed $72,000 in total, but their portfolio would be worth approximately $480,000 today due to compound growth. Allocate 5 to 10% of your portfolio to gold. Gold rose from $300 an ounce in 2002 to over $4,300 in 2026. That is a gain of over 1,300% in just 24 years. Focus on broad market index funds. The average actively managed fund underperforms the S&P 500 approximately 85% of the time, according to S&P Global data. Keep a cash reserve of 3 to 6 months of expenses specifically, so you have money available to invest during market downturns. And think in decades, not days. Since 1928, the S&P 500 has delivered an average annual return of approximately 10%. Through the Great Depression, through World War II, through the dot-com crash, through the 2008 financial crisis, through COVID, through the Iran war of 2026, every single crisis, every single time, the market recovered, and the people who stayed invested came out significantly wealthier on the other side. The data from the last 100 years has already answered every question about whether the recovery will come. It always does. The only question that has ever mattered is whether you will still be invested when it happens. Because the difference between the people who build generational wealth during a crisis and the people who lose everything is never about how smart they are. It is never about how much money they started with. It is always about one single decision: the decision to understand what is actually happening and to stay invested while everyone else runs away.